Yesterday we talked about the stock market and the direction of the stock market moving forward over the next decade and possibly into the future. Number one, if you believe that the stock market is just going to keep ripping up the way it has since March of '09 through today, you don't need me. Nothing I can do for you. Just buy, hold, you'll make a bunch of money. Good for you. You just finished your education piece with us here. If you have a little higher concern and believe that there's some road bumps in the future, let's continue. Okay, for those of you who are still with me, let's go back to that retirement calculator that we were looking at yesterday. When we take a look, these are the original numbers that we put in here for the 45-year-old with a household income of $100,000 and so forth. We can see that that person is going to be broke. Where I want to go today is that I want to talk about different trading styles. I want to talk about a lot of mistakes that traders make when they get into this game. And I want to show you some things in terms of sector rotation and things like that that should help you out. And again, if your concern is about not losing your money moving forward, fantastic. Glad that you're with us. Okay. Number one. When I first started trading, what happened to me, again, was that I was working, I had a job, had a decent job. I was working for the Trump Organization, and Mr. Trump, has a mantra, love what you do, be passionate about what you do, right? So I quit. That's a joke. But in fact, I did quit. And the reason that I quit is that when I was looking at my retirement money, I needed to find out different ways. How can I fix this? What can I possibly do, right? And as I was going through, I was going down to Barnes & Noble, I was reading some books, and I was learning more about the stock market and so forth. And during that time, I found out that there are actually people who do some short-term trading, and they do this for a living. And I said, that's what I want to do. And that's when I left the Trump Organization. I found out that there are different trading styles. Number one, there are people who day trade. They day trade for a living. And a day trader enters and exits a position between the opening and closing bell of the stock market. For that piece of your trading, you go home flat at night. You don't worry about any news events. You're in total control. You're watching the market as the market's unfolding throughout the day and so forth. Most traders are swing traders. And what a swing trader is a swing trader will enter a position, hold it at least overnight. Could be for a month, 2 months, 6 months, and so forth. But generally, within 6 months, you're probably out of that position. Something happened to the position that had you either take your money or accept a loss. Then there's position trading. Position trading gets into what I call the B bucket of wealth. Your A bucket would be your income, and your B bucket would be your retirement money. I consider anyone who's day trading or swing trading to make that an income bucket. Other people are taking a longer-term outlook on the market, holding positions for a much longer period of time. I would call that a B bucket retirement money. Okay? So I want to talk about the different styles. What I did is I went out, I got a couple of books, and I'm sure some of you have done the same thing. Got a couple of books and started trading. Made a little money. Thought you were great. Life is good. See, what happened with me is that, I took what Mr. Trump had to say and say, be passionate. And when I found the stock market, I was like, where have you been my whole life? Well, it hit me in the face every time I watched the news. The Dow was up, the Dow was down, right? So as I'm buying books and learning more about the history of the stock market, finding out that mutual funds weren't the way for me to place my money, have a better understanding of the overall market in order to position my retirement so that I could sleep better at night, have a much higher probability of not being broke in my golden years, right? Isn't that part of the point? I bought a couple of books, and the more books that I bought, I was like, God, this is awesome. And I'd buy a book, and I was like trying to do what the book said, and I was like, well, it looks a lot different when you're trading from the hard right edge, right? Looks completely different. Chart looks completely different than it did in that book. So I'd go down and buy another book, right? Now I'm living in New York. My family is from northern Wisconsin, and so what I did is I was going up to northern Wisconsin for a week's vacation, hang out on the lakes, enjoy my time with my family, right? I fly into Milwaukee, Wisconsin. I rent a car. The first thing I do is I go down to the bookstore, down to Barnes & Noble. I'm all excited because I'm going to go to the books, get a book for my week's vacation. right? Going to the Barnes & Noble, and my God, those are the same books that they sell in New York. There's no new titles here. It's all the same stuff. Go to Chicago, it's the same stuff. I go to Dallas, it's the same books. You go to LA, it's the same books. Orlando, it doesn't matter where you go. All of the traders are reading the same books. Now think about it. Think about this. Who are the people that are buying books on trading? These are people like you and me. People who are trying to get an edge in the market, and so we're trying to buy a book to help our trading. And there's a couple of issues with that. What happens is that it turns you into one of the sheep. You wonder why you're getting picked off in the stock market. It's because you don't understand the game. That's a mistake that a lot of traders make. They say, I'm just going to buy a couple of books and I'm going to do great. It's one of the mistakes I made, and it truly wasn't until I got a mentor and had some coaching that my trading finally started to take off. And it's the same with you. I had one person, he said, yeah, I'm just going to read a book and it's going to be fine. I said, what do you do for a living? He said, I'm a civil engineer. I said, you're a civil engineer. Okay, so you build highways and things like that. I said, yep. I said, do you think I could go down to Barnes & Noble and do your job? Give me a couple weeks reading a book, a week. How about a weekend reading a book and do your job? He said, there's no possible way. I said, well, then why do you think you're going to read a book and do mine? My job is to take care of my family. And so what we a lot of the top traders on Wall Street, and I'm going to distance myself a little bit, Mark Sperling, Evan Lazarus, these guys are phenomenal traders. I aspire to be like them, and that's why I'm here. See, reading books makes it a very difficult and very expensive way to learn how to trade in the stock market. I know many people who bought some books and started trading, and they're like, meh, doesn't make any sense. All I do is I lose money, and then they quit. Well, they never really went through the process, did they? They never truly got an education. So that is one of the mistakes that many of the traders make. Another thing is that a lot of people say, what I'm going to do is I'm going to have a broker manage my money. Just let them deal with it. Well, let me ask you, how have your returns been with that broker, and have you actually taken a look at how much they're charging you to manage their money? I have a friend of mine in Green Bay, Wisconsin, that had a lot of money, and one of the mistakes he made is that he had one of his best friends managing his money. He had a significant account. He had a huge background in the energy business, oil and so forth. Had a large account going into 2007. When 2008 rolled around, the market started pulling back, and in June of 2008, he didn't like the market and he wanted to go into cash. And his broker said, Gary, don't worry about it. You're going to be just fine. This market comes back. It always does. Don't worry about it. Then in September of 2008, when Lehman went out, Gary was spooked. He got out of the cash. He put all of his positions into cash, fired his broker, right? And I was astounded to hear what his broker said to him. He said, Gary, what are you doing to me? Gary, what are you doing to me? Are you kidding me? Gary was down, he was down 40% in his account, a huge account. 40% of my account would really hurt. 40% of his account brings tears to my eyes. It's not even my money, it was so much money, right? And my point behind that is that, does your broker truly care about you, or is the broker really more concerned about themselves? Understand that everyone's job and everyone's position in life is to take care of yourself and your family. And if the market is getting whacked and your account is going down, the broker is still going to be charging you fees so that the broker is able to take care of himself and his family. Understand, from 1980 to 2000, as we looked in the chart yesterday, the market went straight up. It didn't matter what you bought. Buy anything. The market went straight up. You did very well. Over this last decade, the market has been far more challenging. And with a buy and hold mentality that your broker is going to give you, or possibly a lot of you people have, how many of you out there in 2008 held on to your positions throughout that entire nightmare? Nightmare for some, great money for others. How many sleepless nights did you have? Taking a look at the hard-earned money that you put aside, living a responsible life, living below your means, putting money aside so that you can pay for your child's education, living below your means and putting money aside so that your retirement is going to be full and everything that you expected. And the market got whacked. And what happened to a lot of people? A lot of people, they had to extend their retirement. My dad, 76 years old, his best friend, they grew up, they might as well be brothers. They're closer than a lot of family members that I've seen. His broker was his brother-in-law, even worse than your best friend, right? Brother-in-law. Down 40% in 2008. Can you imagine? At that time, 75 years old, 74 years old, and being down that much in your retirement. Well, what did he have to do? He's got a job parking cars at Hertz. Not because he's losing his mortgage and he's going, none of that's happening. The tires are not falling off of his car. But what has happened is because his retirement got smoked so hard, he wasn't able to pull the money out of the retirement that he expected to in retirement. And when his broker said, stay the course, he had sleepless nights to the point where he had to get a part-time job parking cars at Hertz. Do you know what that's like in January Wisconsin weather, parking cars? It's awful. He said, Rick, what do I do? I don't know. What are you going to do, Daryl? It's that's something that you have to determine. It's kind of late now. So again, buy and hold. Buy and hold is not safe. When you take a look at the stock market and the likelihood and probability that the market should at least remain flat over the next decade, possibly go down, and if it goes up, I doubt it's going to stay up with inflation, right? Buy and hold is not safe in this market, right? Take a look at Cisco. I mean, where is Cisco trading at today? $17, $18. You know, even in 2007, it was at 34. Back in '99, it was a lot higher than that, right? $80-some a share. Buy and hold Cisco over the last decade. He went from $80 a share down to 17 bucks. It's a good company. They make routers. They have a huge market share globally on routers and some of the devices that they make, right? Lehman. If you would have asked anybody, including anybody on Wall Street in 2006, will Lehman be out of business in 2008? And there couldn't be a single person on the street that would say yes. Bear Stearns, the same thing. Let's take a look, in the history of, Enron and some of these other things. Is that going to happen again? Well, if you answer that question in your mind that it cannot happen again, I'm not sure you're coachable. I don't know if we can help you. The likelihood and probability that some of these great companies today are not going to be around in 20 or 50 years is there. So you have to understand that when you ask yourself, can a stock go to zero? The answer has to be yes, it can. Is it likely or probable? For a lot of companies, the probability isn't that high. Cisco hasn't gone to zero, it just went from 82 down to 17. So what you need to do even as you're protecting your B bucket of wealth, how are you going to manage that? A lot of people will take a look and they'll just trade based purely on fundamentals. Okay? And the difference between technicals and fundamentals are this. A technical trader is going to take a look at charts, take a look at price action of charts, understand supply and demand. See, I like saying this supply and demand versus support and resistance. Right? A technical trader, when they say support, I like demand because support doesn't really mean a lot to me. It just means, okay, it goes there and it bounces. But what's really happening at that support area is that that's where the buyers are taking over, and it's shoving the price up in a stock, right? Supply and demand. Where are these supply areas? Where are the demand areas? We're going to teach you that, teach you how to read charts and so forth. Fundamentals are taking a look at a company's earnings. What is their growth? How much cash they have on hand, and all of the great things that make a company great. Number one, when you're taking a look at a company's earnings, I mean, is the accounting really, do you completely trust the accounting? Arthur Andersen was a great accounting firm, one of the top 5 accounting firms in the country, probably in the world. I don't even know where they rank in the world, but it was a great company. I had friends who worked at Arthur Andersen and did very well. It was a very coveted position to be working for such a great company. And here you had this great company that was committing this lie with Enron. So now I don't believe that there's this type of fraud that exists on Wall Street. However, I do believe that the job of an accounting firm is to do everything they can to make that balance sheet look as good as possible. So number one, do you completely trust them? There has to be some level of trust here. You know, I'm not, again, please understand that I'm not saying that there's just, you know, you can't trust a balance sheet. You just have to watch, you have to kind of look at it with an eye, which we'll show you how to do. The problem with fundamentals, though, is that fundamentals are purely a weather report. That is all they are. If you, say for example, if you watch a weather report, how about this? The day I got married was one of the happiest days of my life. Beautiful woman. Our families got together. It was a big day. Okay? Now, if the weather report comes out and they say that it's going to be raining on your wedding day, is that something that I'm going to does that mean that I'm just going to go out and just wear all my stuff, you know, because it's going to rain? That's what the weatherman said? Probably not. What I am going to do is that I'm going to take a look out the window, and if it looks like rain, I'm going to prepare myself. Now, on that particular day, I looked out the window. It looked kind of gray and cloudy. You know, might be raining, but it wasn't raining yet. So what did I do? Well, I did what any normal, prudent person would do. I brought an umbrella, right? I brought an umbrella. Now, I'm not walking down the street with my umbrella if it's not raining, right? I just have it with me. Now, as soon as it starts to rain and a little bit of it starts to sprinkle, I'm going to pull the umbrella out, hit the trigger on the umbrella, and I'm going to continue walking down the street, right? It stops to rain, I shake it off, I put the umbrella down, and I put it back in my hand or my bag or whatever, right? That's what we do. See, this is the relationship between fundamentals and technicals. Fundamentals give us the weather report. In other words, they give us a projection of what could happen. And so based on that projection, the price of a stock could go here or there and so forth. Technicals tell us when to pull the trigger, right? So let's take a look at here. Let's go back to the chart that we were looking at from the S&P 500, 1999 to the present. This is that dot-com collapse. Right here is the rally that we had from 2003 up to 2007. Here's your 2008, and this is where we're at right now. Now, excuse me. Let's go back to the summer of 2007, the spring and summer of 2007. What was going on? Number one, we saw that there were some issues going on with the financial sector. There were some problems, right? Remember when we got into the summer of 2007, subprime became a piece of our vocabulary that we certainly did not have a few years before that. If you said subprime on the street, nobody knows what you're talking about. Today I can go to a high school and say subprime, and the kids are going to know what that is. Subprime has become a part of our vocabulary. And so the cracks in the financial system started to appear. Unemployment started to go up. Just started to slightly tick up. Saw some issues with real estate. Real estate prices were going down because there's this huge supply, right? Supply and demand, right? Too much supply in the market, the prices come down. That's part of what happened with real estate. Supply everywhere, right? Ben Bernanke comes out and he decides that he's going to start cutting interest rates. Now, the reason that Ben Bernanke is going to cut interest rates is to make the cost of borrowing money cheaper. Now, the reason that he's going to make the cost of borrowing money cheaper is so that we go into debt. And we continue to go into debt and try to keep the money supply where it's at. Right? Now, Ben Bernanke will cut, and the Fed is going to cut interest rates when the weather report doesn't look too good. They're not cutting interest rates in a booming economy. In fact, they're increasing interest rates in a booming economy. Right? So he's cutting interest rates. Unemployment is going up. And if we go back to the chart, what we'll see is that that was right in this period of time in here. This big red candle here is when Countrywide went out of business, and we knew that there were major issues going on. Then what happened? Bernanke had a huge interest rate cut here. That was August 16, 2007. Market rallied, came right back up into the supply area. Came right exactly back up into the supply area, which also matches the same supply area that we had in 2000. Remember, from 1980 to 2000, the stock market got to the high of that wick, and that's as far as it got. At that point, this is where the sellers came in. Understand that they asked Joe Kennedy. They asked Joe Kennedy back in the early 30s. They said, Joe, you got out of the stock market just 3 months before it crashed, 1929. They said, how did you know? And he said, well, when the guy shining my shoes was giving me stock tips, it was time to get out. But what does that mean? See, that means that if the person shining your shoes is in the stock market, there aren't any buyers left. It can't go up anymore. There's no buyers left. It has to go down. So when we go back to the chart and we see back here in 2000, this is where the dot-com bubble broke. And there weren't any buyers left. They were taking a look at what are these dot-com companies making? They're not making anything. Market share isn't sticking any money in my pocket. The sellers took over and we got whacked. So we know for a fact that the sellers are sitting right there. Supply and demand. If we have sellers taking over, that is supply. It is no coincidence that the next time we come right up to the same point, that the sellers are sitting there. The market, in all likelihood and probability, should come down. Now, when we take a look exactly at this area, remember, we have Ben Bernanke is cutting interest rates. We see unemployment starting to creep in. We see the value of houses going down, and subprime is coming into our vocabulary. Banks have higher write-downs than could ever even imagine, and a lot of them were a little deceptive. I think at that point, I think they're much bigger than what they were reporting. You have to understand that 2008 was the sweet spot. This was a sweet spot where fundamentals and technicals absolutely lined up beautifully. If you got smoked in 2008, it's because you didn't understand that relationship between fundamentals and technicals. Does that mean that you're just going to go out and just start shorting the market all over the place? Probably not. But my guess is that you probably had some type of profits from that rally from 2003 up to 2007. This is a pretty big red flag. We want to start taking some of those profits off the table. You have to understand we're in a credit purge environment. What that means is this. In order to purge anything, you have to go on a binge first, right? Go on a food binge, you may purge it out. Alcohol binge, you're going to purge it out, right? Same thing is true with credit. We went on a credit binge from 1980 to 2000. What happened is that we we started off innocent enough. You want to have a mortgage for a house, you want to expand your business, you need a small business line of credit, blah, 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 blah. Here you go. But it got out of hand. It went from, evaluating whether or not somebody was able to actually pay that money back to the worst, most extreme story I heard was a strawberry picker out in California. Got a mortgage for an $800,000 home. Now, what is the likelihood or probability that that strawberry picker is going to pay that mortgage off? I'd say pretty close to zero. See, that's a credit purge. And that's what we're working our way out of. And this is going to take a little time. Are we going to get there? I do believe we will. We've been through these flat cycles and secular bear markets before. We will work through them. But in the meantime, what you have to do is understand how the market actually works and the different pieces of the puzzle so that you're able to at least profit from it. Say, back in 2007, heading into 2008. Just because we're in a supply area and the fundamentals looks like they're kind of lining up, does that mean you just go sell everything and short the market? No, that's crazy. Maybe for the shorter term trader, yes, that's exactly what you do. But your retirement, you probably want to start taking profits. Because, see, understand that cash is king in a credit purge environment. Right? Let me put it this way. Some people feel that the stock market going down is a bad thing. And my question is this. If prices go down in your life, is that a bad thing? Is that a bad thing? Right? See, we're very smart in our day-to-day lives. I'm sure a lot of you have a flat screen TV. And I'm guessing that many of you didn't go out and buy that flat screen TV as soon as they came out. You said, well, let's give it 6 months. Let's give it a year. The prices are going to come down. We'll buy one then. Right? Saving your cash to buy it later at a lower price. Isn't that what happened in the stock market? Didn't the prices just get hammered? I asked one person, I said, does the real estate prices in Phoenix getting smashed, is that a bad thing? Oh yeah, Rick, that's a bad thing. I said, well, let's ask the question a little differently. Say, for example, you're a newlywed. You live in Phoenix, Arizona. You have good credit, and you have a little money to put down, 20% down on a house. You can buy a whole heck of a lot more house today than you could back in 2006. So are the prices coming down or the stock market going down, is that a bad thing? I think it's a matter of if you understand what's actually happening in the market. It can actually be a very good thing. It can be a very good thing. Buy and hold doesn't work. If you go out and you buy books and you think that you're going to be able to manage these markets by just buying a couple of books, you're going to make it very difficult and you're going to leave a tremendous amount of money on the table, right? Letting your broker manage your money, there's nothing wrong with having somebody else manage your money. But you need to have more, you need to understand more of what's going on in the overall market so at least you can have a smart conversation with that broker. Okay? Trading on fundamentals alone. When we go back to the chart, back to the this decline here of the stock market, unbelievable decline, right? Apple comes out with their iPhone right here, June of 2008. And if you remember at that time, the demand on the iPhone was so high they had lines coming out of the Apple store. Couldn't even go in and buy an Apple or an iPhone. Or if you did, you went in, you go out and you buy an iPhone, what are they going to do? They gave you a receipt saying that, okay, great, you can buy an iPhone. Come on back. Come back in 2 weeks, we'll have them then. What more fundamentals do you need? Apple was trading at around $180 a share then. Fundamentals were fine. Great company. And then what happened when the bottom fell out of the market, the stock went with it. Goes from $180 a share down to 78 bucks. Nothing was different with Apple. Same management team, great products, but what happened is that the market was going straight down. See, you have to understand that 60% of your stock's move is based on the overall market. If the market is going down, your stock is going with it. Now, if you have an extended down period, right, there's an incredible high probability that your stock is going with it. Take a look at your portfolio. Take a look at any stock position. From October of 2007, where the stock market peaked, to March of 2009, where the stock market bottomed, off the top of your head, write down a stock that went up in price. My guess is that you probably can't come up with one. And the reason why is that everything went down. Everything went down. The stock market got smoked, and it didn't matter what the fundamentals were. Your great stock and your great holding went right with it. So again, what we do is that if you sell some of your position, take profits. Now you have that cash available, so that technically, when you see the market starting to rally back up, you can buy the same stuff cheaper. Just like waiting. It's just kind of like waiting for a flat screen TV. We've all done it, right? So keep that in mind. Stocks move based on supply and demand. I mentioned that earlier. In order for a stock price to go up, you have to have demand for that stock. In order for stock prices to come down, you have to have supply in that stock. Now, it's a little funny. The stock market works a little bit different than our day-to-day life. For example, I love raspberries. Love raspberries. Give me a pint of raspberries, and I'm just eating them up. Love them. Now, in February, in fact, I was down in Hoboken, New Jersey. I went down to a grocery store down there. And they had one of those little half pints of raspberries, and it was $7. I was like, $7? I love raspberries, but I don't love them that much. They look like beautiful raspberries, too, but I'm not paying $7 for a half pint of raspberries, because I know that the prices are going to be coming down in a couple of months. See, this is how we work in life. We wait for that flat screen TV. Why do you think some people on the Black Friday, the Friday after Thanksgiving, will get up and get into a line at midnight so that they can go into Target? They go into Target because they know that they get in line and they're the first ones there. They can get these products at cheaper prices. I don't know if any of you do that. I don't. I have no desire for that 3 o'clock line. But a lot of people do. And see, the stock market is exactly the same. See, what happens is that when the price goes up, the demand gets higher, shoving the prices even higher. Or if prices come down, the demand becomes less. So we have to understand sort of like the psychology and what's actually happening in the market. Does that make sense? Good. Supply and demand. Where are these supply points? Where are these demand points? So when I evaluate the market, it's not just one market. We have to take a look at other markets. So let's take a look at NASDAQ. NASDAQ, this is NASDAQ 1999 through right now when this is being taped. And what we can see that back in 1999, that NASDAQ was getting up into an area, it was falling off, it fought and consolidated before the NASDAQ absolutely exploded out of this area. Dot-com bubble breaks, rolls over, kind of fights it a little bit, falls apart, comes right back into this old demand point, and the market falls apart with excess supply. 2002, NASDAQ bottoms, and this is kind of like the bottoming that you see in the S&P 500 going back 2002, 2003, before the market went on to that nice rally from 2003 to October of 2007. You can see right here in this red zone. That was the height of the S&P 500 and the height of the market right before it collapsed. And you can see there's a big move to the downside. Do you think it's a coincidence that the next time we come up to that exact same level, the market is struggling? See, you have to ask yourself, do you know what you're doing? Did you know this? If you don't know these things, you have to question, are you ready to really trade these markets? Let's take a look at the Russell 5000 or the Russell 2000. Here we go. This is the Russell going back to 2000. A little bit different looking chart. However, the highs of 2007 are exactly the same. From 2003 to 2007, we got up to this point up in here, and this is exactly where the sellers took over. Sellers took over. Is it a coincidence that the very next time we get into the same level, which just happened to be a couple of months ago, right? This is this August decline that we just experienced. Is it any coincidence that the next time the leader gets back into this area, the market falls apart? See, you have to understand, this is technical analysis. Nothing too much has changed fundamentally from the overall economy. Really nothing. You know, like the thing that's going on in Europe right now with the euro and so forth, that hasn't, you know, just suddenly changed in July. You can see in the chart that this thing was fighting this area. It had been here before. So right now, when we start putting the fundamentals and the technicals, we start putting them together. Now we increase probability. Remember what I said earlier. Trading is about three things: probability, leverage, and risk. Now we're starting to, you know, take a look at some of the technical things. Let's take a look at some. Let's take a look at some other things that are equally important. The sector rotation. Remember what I said earlier? When you have, if the stock market is going to go down for an extended period of time, your stock is going with it. Stock market's going up, stock is going with it. 60% of your stock's move is based on the overall market. If the market is going up, it doesn't matter what the fundamentals are. There's a higher probability that your stock is going up with it. There's more buying. 30% of your stock's move is based on the sector it's in. Understand that as the market moves, the money moves from one sector to another, right? It goes from, say, consumer discretionary. There's technology, consumer staples, energy, utilities, all of these different places. Now think about it. Back in 2008, I'm guessing that you may know somebody who struggled with their job, or maybe is still struggling with their job today. Can't find a job, or is underemployed, making less money, right? Are they still brushing their teeth? Of course. They're still shampooing their hair. They're buying soap, right? These are consumer staples. If the market is, if there's concern about the markets moving forward, money is going to come out of, say technology, and come out of some of these areas and start going into a safer sector like consumer staples. And the reason why is that regardless of the economy, you're still going to brush your teeth. You're still going to be buying Fruit Loops, right? Love those Fruit Loops. I did when I was a kid. Haven't had them for a while. But you're still going to buy cereal. You're still going to buy consumer staples. Let me ask you this. If you get hit with the economy, are you still going to be paying your electric bill? Yes. Utilities, another safe play where you may want to park money if there's fear ahead. These are the sectors that are going to outperform when there's fear in the market. Now, when we take a look at the sector rotation and where we're at right now, this is the sector rotation going back from April through June. And what you see is that the sectors that outperformed, and this is relative to the S&P. The zero line is the S&P, right? So these are the sectors that outperformed the S&P from April through June of 2000. And what you can see is that the outperforming sectors are consumer staples, healthcare, and utilities. Healthcare, again, another safe haven for your money if there's fear in the market, simply because if you're putting money in healthcare, you know, look, people are still getting sick. People are still dying. People are still having babies. So the hospitals are still going to be getting their money, right? So again, this is a safe place to put money if there's a little fear in the market moving forward. It's called smart money. It's not really any smarter than, that money isn't any smarter than money in my wallet. It's just more of it, right? So we want to watch where the big money's going, because what happens is 60% of your stock's move is based on the index. In other words, the overall market. 30% is based on the sector. Say, for example, if we're in a raging bull market and we see that technology is really taking off, what we need to do from a fundamental standpoint, which Mario and Jordan talk about, is find those great companies, find those gems, find those great companies. In a sector that's outperforming, find the great companies, take them. See, this is how you trade. This is how you manage B money. This is also very good for the short-term trader. If you have great companies, the market's, say the market's ripping off to the upside, these companies are going to outperform the market. So even from a day trading standpoint, it gives you a nice list of stocks to take a look at, doesn't it? Swing trading without a doubt. And if you're going to be managing your long-term bucket, it's necessary. It's required. If you were long financials during 2008, you got smoked. smoked. You have to understand sector rotation. So when you go back to the sector rotation chart, what we see here is that from April 2011 through June of 2011, the sectors that have completely outperformed the market, right here, consumer staples, healthcare, and utilities. These are the safe areas for the big money to park their money so that they don't lose their money. Remember this, trading, a lot of people confuse and think that trading is about making all of this money. Understand that trading is about not losing your money. We have to focus on this first. A lot of traders come in, they read a book and they're like, I'm going to make a whole lot of money. Well, good for you. But don't forget your risk. Because you have to understand the only way that your account is going to grow and truly get to an area that you'd like it to be is to eliminate the big losers. You must not ever have big losers. And so when 2008 comes around and your portfolio is getting whacked, that is what is keeping you from having the probability of having a great retirement. That's one of the things. And so if you are trading and you're not following sectors and sector rotation and where money is going and coming in and out of, you really don't know what you're doing. And I think that's why you're here. And one thing I want to congratulate you for taking the time out to take a look at this stuff. Let's go back to the sector rotation chart here. And what we'll see is that, again, from April through June, the money was going into consumer staples, healthcare, and utilities. I'm going to push this up to today. End of July through September, again, the money in the outperforming sectors are still consumer staples, healthcare, and utilities. See, when we see this money going in before the July collapse, which was what I showed you just before, heading from like April through June, if you go June, July, and so forth, that the smart money was going into these other sectors. That's when we get into these demand or these supply areas. The market falls apart. It's not a shocker. It's not a surprise. It's not like, how did that happen? Right? We see some of these things coming. Remember, we, as technical analysts, we cannot see the future. But what we do have is that when we're analyzing probability, leverage, and risk, I want a high probability on my trade, that the trade is going to go in whichever direction it looks like, right? With a low risk. And you see, you're going to be wrong. You're going to be wrong. And it's a matter of how you manage those losers determines whether or not how your account is doing. And I know for a fact, many of you who are trading are getting whacked, and you know exactly what I'm talking about. You see, what you're doing is that you get into a trade and you start making some money, and you're like, I got to take that money. And you're in a trade and it starts going against you. You're like, it'll come back. And then it goes against you some more, and it'll come back. And it goes against you some more. It's, gosh, please. And then you start making a deal with God. Please, please, God, let me get this back to even. Please let me just get back to even. Instead of defining your risk and understanding when you're going to get out of the trade, when you're wrong, because you will be wrong. And we want to keep small losers. Never have the big losers. We have small losers. We have small winners, and we have big winners, right? Understand and having the psychology of letting a stock trade that is going in your favor, how do you recognize it to let it run, right? Having that occasional home run, that's okay. I'm a singles hitter, and I get the occasional home run. Occasional double, occasional triple, and so forth. But singles, consistency. Take a baseball team. If you take a baseball team, they have a lot of home run hitters, and a baseball team that is just loaded with singles hitters, they're probably going to win the baseball game. Single, 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 out, single, 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 home run, right? Versus strikeout, 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 right? We don't need to be swinging for the fence on every trade that we take. We want to understand what our risk is. Where's our reward? Make sure that relationship is intact, right? So we need to put the pieces of the puzzle together to give us a higher probability on the trades that we're taking. Understanding sector rotation is a big part of that. Let me ask you this. I'm talking about probability. I'm talking about risk. Are we gambling? Sounds a lot like gambling to me. You bet we're gambling. I hear a lot of people say, yeah, the stock market. No, we're not gambling because this and that, but for and the other thing. Yeah, we're gambling. But you have to understand is that, see, we have the mentality and we gamble like the casino gambles, right? If I walk into a casino and I belly up to the roulette table, I put my chips down, the casino is gambling. Because understand, there's a possibility that I could gamble and put my chips down on the table and actually leave the casino with more money in my pocket than when I came in. That's possible, right? So we are gambling. But the likelihood that I'm going to continue to take money from the casino consistently through time by playing roulette, right? The likelihood and probability that I'm going to just make money through time is very, very low. They have the advantage. They have probability on their side. See, they have losses. They manage their risk. If I go into, say, Caesar's Palace in Las Vegas and I want to put $100 billion on red, they will not take that bet. Because even though they have probability on their side, the risk is so great that if they lose that bet, they just lost the casino. And the same thing is true with your trading account. You have to define your risk. You have to pick your battles. You have to take a look at where probability is high, risk is low, hit the trade, and when you're wrong, accept it. Okay? So how we do this is through a trading plan. You have to have a trading plan. Now I'm going to ask you this. Do you have a trading plan? Answer yourself the question. I know a lot of you are going to out there and say, I'm not really sure what a trading plan is, and what does it include, and I don't know. No, I don't. A lot of you are going to say, yeah, I've got a trading plan. I'm like, great. So the follow-up question, if you have a trading plan, can you go and just go to your computer and print it off right now? And if the answer is no, you do not have a trading plan. You must have a written trading plan. You have to understand why you're in business. What is it that you're actually trying to accomplish? What are your rules of trading? And that is going to increase the probability. That is going to lower your risk and increase probability. Isn't that what you're trying to do? You're trying to increase probability and lower risk? You have to write a trading plan. See, I'm a coach down here. I can help you with that. Okay? I want to get ready to finish up here that one of the best things that I heard when I first started trading was that you do not need to be smart to trade. I was like, thank God for that. You don't. You have to be coachable. You have to be willing to have an open mind. If you have that, we can take you to the next level. You don't have to have a master's in finance. You don't have to have your head in the Wall Street Journal reading every single page, right? But what you do need is a mastermind group. And what a mastermind group is a group of people who have something in common that you want to achieve. How you get good at anything is you find those people who are already good at it, and you just do what they do. This is how you get good at trading. This is how you're going to take your trading to the next level, is you get those people. We got some of the top traders. Mark Sperling, Evan Lazarus, fantastic, phenomenal guys. See, and you need that coaching, you need that mentoring. Tiger Woods, when he was #1 in the world a little while back, we all remember that, right? He was the #1 golfer in the world. Even when Tiger Woods was #1, he still had a coach. He still had somebody helping him. Correct. He wasn't reading about golf. He wasn't reading an article written by Jack Nicklaus. He had a coach. He had somebody who was there holding his hand, helping him, say, no, Tiger, you got to move your hands a little bit. And now what we do is we have the likelihood and probability that Tiger would remain #1 very high. Got to have a coach. And if your game isn't at the top, and you're trying to do this without a coach, this is another mistake that you're making. And you have that choice. That is your choice. If your account is getting chipped at, and you're not getting mentoring, or you're not doing whatever it takes to help you get to the next level, I have nothing to say except that you probably are going to continue to experience the same pain that you're experiencing right now. You are the elite. You are still watching this. So that makes you different. That makes you that gives me hope for you. Right? That's why you're doing some of this stuff. You have to continue, though. Education doesn't stop when this video ends in just a few minutes. Go back to I'll go back to this retirement calculator, and again, what we need to do in order to give peace of mind so that you are not going to be losing sleep in your retirement future, the best way that you're going to have the likelihood or probability that you're not going to be broke in retirement is to change the returns. Change the rate of returns. Let me just change this, say 12%. Boom. Have your rate of return during retirement just a little bit higher. You got a legacy there. You're living to 100 years old. Is 12% too high? Is it too aggressive? I don't know. I really don't. Is it? I think that if you are taking control of this stuff, I think you have a higher probability of hitting some of these higher numbers than if you just let somebody else do it. Obviously, in this stock market, with the market being flat and really struggling over this last decade, you need to do everything you can to make sure that you're able to take care of yourself and your family in retirement as well. It's not about just today getting a job and spending that money. It's about being able to take care of yourself and your family in retirement. And you need to have mentoring. You need to have coaching and so forth. Imagine the possibilities. Imagine the possibilities. If you're able to put a plan together, maybe do some swing trading, you keep working your full-time job where you're able to start making money on a monthly basis. Imagine what that does to your life, how that changes your life. Imagine your sleep pattern going into your 60s if you know that you're okay. This is what we're talking about. And with that, have a great day.